Okay, hello folks. Welcome to State of the Market. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today's October 21st. Just show a few quick disclosures to start. Interesting things happening overall. I'm going to cover a few points, go a little bit even beyond the sector indexes because I do think there are some things that are at least worth very quickly mentioning. First, I will show you some standardized returns. These are some of the ETFs that we're going to be looking at. Remember in this webinar, we look at some of the big ETFs that represent sectors. They're just in a convenient way to kind of look at these overall things. Looks like I have EWZ there twice. I'll remove that. Anyway, interesting sort of situation. So far, we're holding kind of a low that was very interesting. That I'm going to be getting to. It was a low back on, I think was it October 11th. The high of October 11th that was support last week that today we're kind of holding above. Kind of continuing to show the tightness at near highs, which is not necessarily a bearish sign. I'll also remind everyone that I'm going to be in Miami the week before Thanksgiving at the Crossroads Summit, which TradeStation Group is sponsoring. CrossroadsSummit.com is a website. There's going to be some really interesting speakers talking about changing trends in the world of business and economics, and I will even be interviewing some of them. So hopefully you can make it November 21st and 22nd. CrossroadsSummit.com if you want to check it out. It'd be great to see if anyone watching it wants to come out and check out this event. All right, so we're going to start off by looking at the S&P here, and the weekly chart of the S&P. What's interesting to me is now, I mean, Monday inside, inside so far, but look at the high from back here on October, um, basically 11th. See this high, and then last week we went under it for a day, came back, went under the next day, closed above it, and now here we are today. Our low is 58.24, and that was 58.22. So this is to me kind of what we're seeing here. This is to me a pretty important signal. Remaining above that to be a higher weekly low. The 10-day moving average. We talked about this in market trends, but it has not been rising for very long. So to me, this is really the key thing to be watching here. I will note that Goldman Sachs put out some note today saying that the S&P is going to average 3% annualized returns, for the future, something like that. I mean, you hear these things, but at the same time, we have to remember that yes, the S&P is trading at high multiples, but earnings growth is supposed to accelerate into triple digits after the current quarter for the next 3 quarters, according to FactSet and some other people. So when you look at those things, very often multiples expand before the actual fundamentals catch up. So it's just something to kind of bear in mind. Is that we're at a spot here where you look at some of the economic data. If you look at things like GDP now from the Atlanta Fed, it was pretty strong. It's been trending higher, so that could also drag up earnings estimates. I wanted to kind of point that out. We did that note from Goldman that I think some people are probably going to be talking about, but it is just one thing. So let's see now. Some of the other things that were kind of interesting. If you actually want to look on our blog, we do have this article that I thought was interesting. You might want to take a look at some of the things we said in here. But what was interesting to me was that basically, the advanced decline line last week made a new all-time high. And then I think it's interesting, some people talk about things like the fear and greed index on CNN being overly bullish. But if you actually look at other things like from the American Association of Individual Investors, or you look at National Association of Active Investment Managers, if you look at things like margin debt, which comes from FINRA, none of those things are overly torqued to the upside, like people overly euphoric or anything like that. I think it's just kind of interesting. There's no real clear signs, from my perspective of the market being overbought. Things like RSI have not been overbought. Stochastics have not been overbought. The distance above the 10-day moving average, which is an indicator we use sometimes, is not extended. There's another thing we talk about in state of the in market trends about how long the 10-day moving average has been rising. It's something called price streak. We're not going to do it today, but it also has not been rising very long. So a lot of the things that occur at places like this are not present. And see, in this case, the 10-day moving average was rising for a long time. Here it's been rising for a shorter time. I'm not going to give the exact numbers. I've told people how they can find that. We do have these indicators available in our workspace that we share on Thursday in market trends. If you go into that and you look for price streak, you can do that on the moving average streak. You can see that in that indicator. So overall, I think when we look at this, it's been, obviously things have been trending higher, but there's not a lot of clear signs negatively. And then when you look out into the future and you look at earnings coming up and things like that, there's also not necessarily a lot of things. If you want to be, structurally bearish, you might not find a whole lot to kind of justify that position. So I want to just mention that. Now, um, before we go on further, I want to mention potentially something I think is interesting that we've been seeing in things like gold and silver. These things both been trending higher. We talked different times about things like silver, and here's silver kind of hitting its highest level in over 12 years last week. I think we might be at an interesting time in history right now for things like precious metals, because it has been this idea of this global thing that they're going to, this BRICS currency thing that's coming up. But if you look into it, I mean, it is, if they succeed in doing this, it's going to be 40% gold. And silver right now is historically at a relatively lower ratio relative to gold. And at the same time, we've basically seen um, with central bank cutting interest rates and things like that, we could be at a kind of a tipping point here. The fact things like gold and silver have been doing so well at a time when stocks are going higher, at a time when interest rates have gone higher, despite the Fed cutting rates, we've seen the longer end of the curve move higher. This is potentially consistent with a secular bull market in precious metals, which we have not seen in a long time. And I think I want to just point that out. To me, this is something we might want to, we're talking about earnings and tech and AI and blah, blah, blah. And then we might have a bull market in gold and silver just emerge while no one's talking about it. And I feel that, we try and identify these things in these webinars. We try and look where the price action is. I just want to point out one other thing. This is our article today. If you go to tradestation.com, I'll stay ahead real quick. If you're on like tradestation.com and then you click on insights at the top of the page, this is the article here, but if you go to TradeStation, up here is the actual link to our blog. It's called Insights. If you go to that, it's the top article, the gold and silver bars on it. But what's interesting is, down at the bottom, look at the bottom, because I found this fascinating. When I show these ETFs, I show standardized returns for them as well. So you can see year to date, gold miners have been catching up. It's really interesting to look here right around this point at the midpoint of the year. Semiconductors basically flat to down, gold miners really coming to life. So if you look on a year-to-date basis, gold miners are still lagging. But if you look really in the intermediate term, there's something of a dividing line right through the middle of the year, a little bit before the end of June, that is interesting. So that's about a halfway mark through the year. Interesting. Now, the other thing that's very interesting, look at the bottom. We have our standardized returns of the 10-year returns of the GDX gold miners against SMH semiconductors. Gold miners have actually, I mean, for a 10-year performance, 80% is not very much relative to the S&P and most other things. It's clearly lagged the S&P in this time. 10-year performance. Chips are up 800 something percent. Semiconductors are up 80. I mean, gold miners are up 86%. So the thing is, if people are looking for a long-term secular shift, if it is happening, which maybe the price action in actual physical gold tells us, this is something that, people might say, wait a second, these guys are still lagging. Why is gold at highs and why is the gold miner ETF not at all-time highs? Why is silver not at all-time highs when it's been outperforming? And so just want to mention this as something that might be brewing in the background. We're not going to often get into things like gold and silver miners on this webinar, but this is something that I think there's a lot of commentary with this BRICS summit, which I believe is this week. Doesn't get enough attention in the American media, but gold and silver are global assets, and this is just an important thing. I think that we, at least I feel that people should at least know is potentially happening. There is a lot of information happening about it, so I wanted to mention it. All right, now the cues. Here we basically have just kind of pausing and sitting, and right now there's just a bunch of earnings coming up that it's kind of a wait and see mode until that happens. And the big earnings are kind of closer to the end of the month. We have several different things at the end of the month that I'm going to mention. So right now the cues are just kind of sitting, and it's an inside week, and I don't think there's really much to say or do, really at this point in this, except to kind of watch it. And at this point, um, it kind of depends on your view of large technology companies. Essentially, it's lurking which some people might see as kind of giving a potential for breakout, but it also might be viewed as something where if the market, this could be the first stage of a pullback in the market. Because if you look back in July, once the Nasdaq started breaking down, it broke down for a couple of weeks before the broader market. So the one thing I think we have to at least entertain as a possibility here is that if the Qs and the Nasdaq do not push to new highs, that could be something that is kind of troublesome. So I think with these earnings and stuff coming up, we just have to realize that it hasn't broken out and the broader market has. And the last time something like this happened, it did cause the kind of pullback we saw over the summer. But for me, it's all about the calendar. Let's not overthink the chart when we know there are these clear kind of calendar events. Now, the Dow is also just kind of at a point where it has, moved pretty, a lot. It's been up for like 6, 7 weeks or something, and here we have an inside week. I think right now people might be just looking for the low of last week as the first sort of potential support on something like this. Now, the Russell here is something where we had last week the highest close, but we are not holding it, and I'm going to get to this next. But to me, I mean, honestly, there's something strange. There might be something weird happening with treasuries, and it might be connected to what I said about gold and silver. So I think we just have to kind of, realize here's the Russell pushing up and now really not managing to hold. And, at this point, I think we have to kind of see if we're going to get a confirmed breakout above the old high. This has been something that's been consistently just kind of um, a frustrating sort of thing, and it's highly sensitive to yields. Now, the one thing that's interesting on it is if we look over on the daily chart of the Russell, is that it is holding essentially a 50% retracement of this move. Now, in my book, that's not necessarily that meaningful because it's not really on a week-to-week level. This is the range that this could be something where if it holds here and then, there's also potential support across here. But in my view here, this is something that's now very sort of tricky. It is range bound. It is potentially not breaking out at a time when yields are moving higher. So overall, there's an interesting sort of thesis for the Russell, but there's also the issue of the fact that we have the big earnings coming up first. And the other thing is, if there is going to be a big rally in the Russell, maybe it's next year. Maybe at this point in time, people have to close this year out. So this is now one for me that without a confirmed breakout, this is something that could be kind of tricky and painful for people. Now, the real one that is painful and I think is interesting is the 10-year Treasury yield. This has advanced more than kind of seemed likely, and now we have a second trend line. We had a trend line here that it broke through. We have a second trend line up here that it's broken through, and to me, that's a little bit of a bigger potential issue here. Now, this high became a low, and I think this is also something we really have to be careful of because the fact that we have the Fed cutting rates and yields, the 10-year yield moving higher, this is something where people are probably looking out and they're seeing the increase of deficits in the future, the risk of higher inflation, not now, but out farther into the future. And I think the other thing is really, I mean, if you look at the long-term situation, the central banks around the world want to hold fewer treasuries, and with things like gold and stuff happening. So I think we just have to realize that there's a potential here that we are seeing something of a shift of the demand for treasuries, where you might say, well, inflation's coming down, the Fed's cutting rates, those are fundamentally positive. But the thing is, like anything else, treasuries are an asset. They have supply and demand, and if there's too much supply of them and not enough demand, their prices go down and their yields go up. So I think right now we might actually be in a spot where the real story in treasuries is a global weakening of demand, regardless of the fundamentals. And that could be a problem overall for our interest rate sensitive parts of the market. So this is potentially a new trend, and it could potentially create bigger issues for American equities if it continues over time. And I think we have to just kind of be aware of it, as this is something that to me is emerging as a potential risk. Even when we see evidence of inflation coming down, and we've seen more and more of it. Like the German PPI was soft. We had some good data. The data overall has been pointing where the Fed wants it to be. But then at the same time, you have the basic issue of, for a long time, global central banks were holding treasuries, and if they're buying less, and then they want to start shifting to things like gold because of things like this other currency system potentially taking shape, that creates a secular change that isn't potentially important, and I feel that we should at least know it's happening. What is interesting, though, if you look on the daily of the 10-year, is that it's holding approximately a 50% of this move on the daily, basically from this point in April down to here. Right about there's a 50% of it. If it gets much above it, though, it would basically invalidate this move, or potentially kind of suggest that this move isn't really that important, and that would actually be something that would be potentially, problematic for equities as well. So I think right now we have to really realize that things could be happening with the Treasury yields, and it has been a good signal in the past. At different times in Treasury yields, like last summer or 2 summers ago in 2023, as it pushed higher, basically the stock market started getting weak somewhere as it moved higher, and it dragged the equities lower. So this is something I think we just have to realize could potentially be happening. Now, materials are one we've talked about, and this gives something of that sort of signal here, where it had closed above the old high, and now it's kind of holding and kind of sitting and doing an inside week. From my perspective, this is kind of consistent with the sort of thing that might be what people are looking for, in terms of confirming a move higher. So from my view here, if this kind of holds its levels as the week moves on and we don't retrace much more, this is an area where it might actually be something of a signal of this accelerating higher. Now, the wait, actually, let me go to XLB again really quickly. On XLB, we also had, no, I'm sorry, there's no other signals here. This is one where, let's just see how it behaves over the course of the week. Now, XLC Communications. This is one where we Google reports on the 29th, Meta reports on the 30th. It's just kind of squeezing in here. It's holding these tight levels. And I think for something like this, we just have to realize, with these events coming up on the calendar, that kind of, takes that monopolizes and sucks all the oxygen out of the room on this. Now, XLE Energy, this one we have talked about, the situation with energy, with basically too much oil in the world. And it's pretty interesting. Today, the International Energy Agency was warning about weak global demand for energy. The IEA and OPEC have been basically, mudslinging each other for the last 18 months over, is there demand for oil or not? And OPEC keeps saying there's a lots of demand for oil, and IEA says no, there isn't. Recently, OPEC has been saying, you know what? IEA seems to actually be right after all. So IEA has been the more credible of the two on the research side, and the forecasting side. They came out and said there's very weak global demand. There's some people at Reuters. I find some of these guys at Reuters who do energy, they seem to be very knowledgeable, and they were basically, there's a guy at Reuters who's basically saying that China has like 1 million barrels of like unused crude. I don't know if it's every day or every week or something, but if you look, basically they're saying is China is amassing unrefined crude because there's not enough demand for gasoline and refined product. So I mean, this story of China does remain this continuous thing. And I think one of the things we have to realize is, no matter what I say about treasuries, no matter what people say about situations globally, no matter what they say about the election, tariffs, deficits, all those things, at the end of the day, I think we have to realize is that crude is facing a situation of weakening demand, high supply. And I continue to point to the fact, I think if you look at the long-term chart of crude, which I think I can do here. Actually, I don't have it readily on this platform, but from my view here, we still have to realize is that energy is in a situation that might basically help a lot of different things and pull inflation down. So the situation energy here, people might see XLE having space down to 85. That kind of remains what I've been watching here. Look how it's trying to hold this 90 level. There was a high in September. It was multiple months here, this 90 level. If you look on the chart, it was basically weekly highs. all throughout September, multiple months, 3 weeks in September, it was a high. Now we're trying to hold it as a low. But from my view here, the big range is 94 down to 85 and a half. And, people might look down to that area. XLF. Now, this is one that might need something of a tactical pause. We have now it's forming an inside week as well, and I think this is one where as well it's had this strong sort of move, and people might just want to kind of be watching to see and let it rest a little for a short time. But overall, this is now broken out into new all-time highs. We have essentially a situation with a steepening yield curve and promising economic growth. There's a lot of things about financials that are potentially sort of um, you can see a potential in. So I want to just kind of point this one out. This one we kind of mentioned was in a secular move to the upside, and now it has kind of confirmed this breakout. So for me here with XLF, it's just a question of seeing maybe we hold a half this candle from last week, but now it's a question of we have a confirmed breakout, and it might just be a question of letting it kind of get, you know, this is what the first day down after how many days up, for like 6, 7 days up. The second or third day down might be where people get more active. There is also this level on XLF from right here at 46.85. This level was basically the high on the 14th and the low on the 15th. That sort of thing right here at 46.85 might be where people look at some potential sort of areas. So XLI, the industrials, this basically puts us right back at the same sort of situation now of being up for like 6 or 7 straight weeks, tight inside week. This might be one where people look for a period of pausing and then maybe a few days of weakness that could give us an entry closer down to 136. That might be something people looking on that, this kind of high along here. But this tight, I mean, yeah, it's a weekly, it's not to say that it'll definitely happen, but from a risk reward perspective, people looking for an opportunity or a potential entry that might actually have more sort of a pullback with potential for, from a risk reward perspective, a move down to this high or even back kind of a little bit lower down to like 134.90 ish, which is basically this area around here. That might also be kind of down into this zone, might where people are looking on the XLI energy industrial ETF. Now, XLK basically just doing a tight little bullish inside week, but again, October 29th through 31st is all that matters now. That's when we have, Microsoft, Apple, AMD, Tesla, and some other big tech names. This is also one here where, it might be something when people actually look to push it a little bit closer to earnings, running into earnings. But right here, I think it's just have to realize it's going to be, it's just kind of pausing and waiting. And it's interesting to see that we're basically holding above, this high from back here in late July and mid-August, this level around 227.23, and I think right now that's a potential signal here, but this will ultimately hinge upon earnings. The consumer staples XLP is basically here also in this spot where it has pulled back and held, but this is a slow moving sort of thing, and people might be just looking for this to kind of chop and consolidate, and maybe do something kind of like this when it kind of bases for a longer period of time. Not much of a fast mover. Remember, the big name in this actually is Walmart, which reports later in the cycle. I'm not sure what their date for reporting is, but these retailers tend to be later in the cycle. So something like that, I think we might want to just bear in mind for the consumer staples. Now, XLRE, the REITs here, this is something people might actually kind of see now as being this kind of range here between about 45 and a half, right around here, down back down to like 43, this sort of range. And the problem now is the situation with yields moving higher. This is something where REITs have not broken out, and unlike utilities, they have the situation with interest rates and um, they don't have the kicker of utilities that are benefiting from AI. They're kind of like these office buildings that still have issues and a lot of other stuff. So I just want to point this out about saying XLRE. This is something here where people might actually say, all right, it failed to break out, is making a lower high on like the monthly chart, and maybe it just needs to pay pay the piper longer and have some more weakness for a while. So XLRE here had a nice move, but at this point there might be reasons not to trust it. XLU, this is one where it's also just kind of consolidating here potentially. It's above the old high from back here in September, but I think you look at this on the weekly now. There's a spot where a lot of this has been kind of priced in, a lot of the kind of opportunity of this to grow and stuff. So this might be something where people look for a period of consolidation for a few weeks and look for potentially lower down the range, kind of you know toward last week's low, maybe potentially down towards 78, and see if it fills through here for a while before it really can progress to new sort of highs. That might be kind of how people view something like utilities here. And there might be some nervousness when they look at what has been happening with yields. Say, let's just make sure yields are not going to go much higher before we start really getting too active in utilities. XLV here, the healthcare has, it has this rising trend line that potentially kind of comes into play. And this is one where um, this has been a very sloppy sector. There's been some real problems with things like UNH and some of these the health insurers. Um, I do think one thing that is interesting though is that there are other companies, like especially the hospital stocks, that have been outperforming because with people getting more medical treatments done, it's bad for the health insurers that have to pay the bills, but it's good for the hospital stocks that actually charge the bills and perform the services. So if you look inside of healthcare, there's a real kind of split between these. The health insurers are mostly the really big names, along with some of the big farmers, and the hospital stocks are not as big in terms of market cap. But I think it's an interesting sort of split happening inside of the healthcare sort of sector. But I think right here, when we look at this, this is something that has, with the election and everything else coming up, people might be just looking for this to get cheaper before they get interested in it again. And now XLY, consumer discretionary. This was one that I think we also have to realize Tesla reports the afternoon of the 23rd, 2 days from now. The 23rd is Wednesday evening. Um, but this one also has not broken out, and Amazon then reports on the 31st. So I think the problem here with XLY is the fact that essentially these are consumer discretionary names, but they are also large cap growth stocks that potentially have different kinds of issues. I mean, Amazon in many ways is not even a consumer stock now. It's really like a cloud computing stock to a certain extent. And Tesla is its own sort of animal at this point in time of where it stands on things. So, from my perspective, the XLY is kind of getting broken as a sector. It's kind of becoming, kind of a little bit, I don't want to say useless, but it's not really reflecting the reality of what's actually happening. I want to mention though, I am watching something I think we should think about, which is that the XRT, some of these traditional retailers. What's interesting about these is that these sort of stocks, are more of the traditional retailers, and a lot of their earnings are going to start coming more into November around Thanksgiving and stuff. So I want to kind of mention that when you look at where we are, this is something that's really been sitting, and I've been kind of watching this now as something that might be, more of something to watch. We have a potential line around 79 on the XRT, and we have, on the kind of weeklies here, we do have a series of higher lows inching higher toward this earnings season for the traditional brick and mortar retailers. So with gasoline coming down and everything else, all of these I think are potential points just to think about. So, I might be setting some price alerts and watching some of these as we get closer to that earnings season. That might actually be something that, is more consistent with the current state of consumer sort of spending. All right. So those are the main things I wanted to cover. Let me just make sure I didn't miss anything. Um, I am about to do a trading view idea on DKS. I can just say that Dick's Sporting Good. It's kind of interesting if you look at this. We did a trading view idea on it somewhere back here as it broke out and moved to new highs. And it's interesting to me here to see that it has kind of this trend line that's trying to get through, and it has these series of higher lows, and it's more or less held above these old highs. It's kind of interesting. So I wanted to mention this because this is an area where the retail sales last week was good and everything else. I continue to think that the overall situation of the consumer is pretty healthy. And I think that people, for various reasons, and I think people are just unhappy about politics or unhappy about the country. They say, "Oh, everything's terrible. I'm negative on sentiment." But the fact is that if inflation starts to trickle through and improve, as a lot of indicators are, we are in a situation here where a lot of that really negative sentiment might kind of start to dissolve. And the key question is, will it? And if there is a time when it could be, I mean, will it be this holiday shopping season? And I think that that might actually be something just to kind of consider as a possibility, because the overall sentiment is not reflecting the reality of people's actual economics when you look at all the different data that's out there. So I want to just kind of mention that I've been saying this for a while, and but now I think with with the earnings calendar coming up about 3 or 4 weeks away from the big retail names, that might be something that doesn't get a lot of attention, but maybe it's something that actually some people start to think about. So I'll see you guys on Thursday at 2 p.m. when I do market trends. Hope everyone has a great day, and I'll see you in a few days. Thank you very much.